this welcome to this session of strategic financial management. Due to the network issue, whatever we discussed regarding the problem in the last session could not be heard. So regarding the problem one, see, the things which are being given here is that the earnings before income and tax that of the company X is rupees 20 lakhs, and that in its capital structure it has two funds, that is equity shares and the debentures. Now the equity share, the book value is would be 4 lakh into 10 each. That would make 40 lakhs. Now the 40 lakhs represents the book value of the equity. But the question tells ask you to find out the value of the firm. Now, when the question has asked you to calculate the value of the firm, here we should always remember that it is the market value of the firm, and also that you know there is one more which has been mentioned, that is redeemable debentures. Now, redeemable debentures are 25,000 of bonds has been issued. Now, each of the bond would be having 150 rupees each. So, the entire value of this would debentures would be coming up till it is 37 lakh 50,000. Now, one thing we should remember is whenever we evaluate the firm, the value of the debentures is going to remain fixed. It is the book value, right? But then when it comes to the equity share, the face value of the shares and the market value of the shares would be different. So how to calculate the value of the firm? We shall see. Now whenever a problem is given, it is always suggested that you maintain or you solve the problem in terms of solving it in a table. So that one who tries to evaluate your paper can clearly understand the things that you have made. Now, now, instead of doing like this, it is always better that we do it in the form of, writing it as calculation of, it is better that you, before starting with the problem, we should write calculation or the table showing the calculation of value of the firm under net income approach. So we have the particulars, and in the amount column definitely we would be representing in terms of rupees. Now, what has been given? The first thing that the problem speaks of is earning before interest and tax, or the EBIT. Now, the EBIT directly they have given it to be 20 lakhs. Now, whenever they have spoke regarding EBIT, it simply means the earnings of the company even before the interest and the tax has been paid. But under net income approach, what is the first assumption that we have made? That there are no any corporate tax. So, it goes without telling that here still there is something to be deducted even before we decide what is the income that would be available for the equity shareholders, or what has to be divided in the form of dividend for the equity shareholders. Here yet again you have to remember that one of the general assumptions is that whatever the company earns, the entire amount would be given for the equity shareholders, and that there are no any kind of reserve fund that has been maintained by the company. So once you have EBIT, from that we would be deducting interest. Now, what is this interest, or how shall we calculate interest? Is that first we'll have to find out what is the total amount of debt that we have. The total amount of debt is 25,000 of bonds has been given. Now each of this 25,000 bond would be of a value 150 each. So it is 20, so it would be 25,000 of bonds. Each of the bond would be of the face value 150. So when you multiply these two, you would be getting 37,50,000. Now this is the entire value of the debt that has been given by the company. Now if we observe that now to find the interest that has to be paid, we'll have to know the interest rate. And the interest rate happened to be given in the question telling that it is 14%. It is 14% secured redeemable debentures. So each of the share, that is to tell each 150 rupees share will be having 14% interest on that. Okay. Now when you multiply this 37,15,000 by 14%, the interest would come up till 5,25,000. Now, so to find out earning before tax, we'll have to deduct the tax amount from earning before interest and tax. And we will get a amount of 14,75,000. Now this is also earning before tax. But according to the assumption, we have assumed that there are no any tax which is considered under net income approach. That's why we are never going to consider tax, and that's when your EBT becomes NI or net income available for equity shareholders. Now, according to the assumption, this entire 14,75,000 has to be distributed among the equity shareholders. Now, for us under the question, we'll have to find out value of the firm. For us, what is the total value of the firm? That is what matters. Okay. We need not calculate what is the value of each equity share. The value of each equity share would be nothing but the entire amount divided by number of shares. But then, before that, we'll have to find out what is the market value. Now, if we do not know what is the market value of the equity shares, how are we going to find out how much each equity shareholder is going to get? So, now this market value of the equity, if we try to remember the notation, it has been mentioned as yes. Now S represents the total market value of the equity, B represents the total market value of the debt, I represents the total interest paid, and V represents the total value of the firm. So here we have to find out the total value of equity, which is represented by S. Now in the question, if we see, they have given the market capitalization rate to be 16%. Now this market capitalization rate is nothing but the cost of equity. Now the market capitalization rate would be 16 divided by 100, which would be 0.16. Now this market capitalization rate is nothing but your KE, or cost of equity. Now here, when you have to find out the total value of the equity, you have NI, or net income available for equity shareholders, and you have cost of equity KE. So when you divide the total market value of total net income available by the cost of equity, you will find out the total value of the equity. So 14,75,000 divided by 0.16 would be coming up till 92 lakhs 18,750. This particular amount is the market value of equity shares, or in other words, it is the entire value of the equity of the company as of today in the market. That is to tell, if you sell all the equity of your company in the market for the day, for your 4 lakh shares of rupees 20 each, which is a total of 40 lakhs, you would be getting 92 lakhs 18,750. Now this happens because the equity is traded in the market, and with the increase in the value of the firm, the value of equity also increases. And the next thing that we'll have to say is, we have to find out the value of the firm. And under net income approach, it is said that the company is made up of two components. The capital structure is made up of two components. One is debt, one is equity. Now that we have found out the value of the equity, one more thing that we'll have to find out is the value of the debt. Now speaking regarding debt, the thing is, it is not traded in the market, and the value of the debt is going to remain constant. So we here have 25,000 of bonds which has been issued, and it has been issued at rupees 150 each. So which is going to remain constant, and that's where the market value of the debt is found. 25,000 of 14% secure redeemable shares multiplied by the face value of each bond, which would be giving us 37,50,000. Now that we know the value of the debt, now that we know the market value of the equity share, we can find out the value of the firm. Value of the firm is represented by V. Now, market value of the debt is represented by B. So, the total value of the firm V is equal to S plus B. That is, we add these two values. So, we will get the total market value of the company to be 1 crore 29 lakh 68,750. Now, this is the value of the company as of this day. Now, what we should always remember is the value of the debt is going to remain fixed, and the value of equity, because it is traded in the market, is going to change. Either it appreciates or it depreciates. Now, the first thing that we had to find out was the value of the firm, and we have found it out to be 1 crore 29,000, 1 crore 29 lakh 68,750. Now, next thing that we'll have to find out is the cost of capital, or the overall cost of capital. Now, this overall cost of capital is represented by K naught. Ki represents the cost of debt, or Kd represents the cost of debt, and Ke represents the cost of equity. The overall cost of the capital would be including the cost of debt also, cost of equity also, which is represented by K naught. Now, regarding the overall cost of capital, we have the formula K naught is equal to EBIT divided by the value of the firm. K naught represents overall cost of capital. EBIT represents earning before interest and tax. V represents the value of the firm. So, if you know the formula, we can have the earning before interest and tax, which is given to be 20 lakhs. And we have found out the total value of the firm, which is given to be 1 crore 29 lakhs 68,000 and 750. Now, this is the formula which we use, and when we divide 20 lakhs by 1 crore 29 lakhs 68,750, what we would be getting is, into 100 we'll always have to do, what we'll get is 15.42%. Now, this cost of capital would be represented in terms of percentage. So, once after you do that, you will have to multiply it with 100 so that you can represent it in form of percentage. Now, this is when you know the formula. By chance, if at all you forget the formula, there is one more method wherein which we can find out the overall cost of capital. Now you know the value of the firm. It is 1 crore 29 lakh 68,750. It represents the 100% of the company. And on the other hand, you have EBIT. Right now, EBIT is nothing but it represents the overall cost of capital. So, if you can find it out by if 1 lakh 29,000 1 crores 29 lakh 68,750 is 100%. In front of that, what percentage is represented by 20 lakhs, and it will also give you the exact same amount. Now it is nothing but the explanation of this particular formula. So once after you do this, every time for every problem you'll have to give conclusions. Conclusion telling that according to the problem, under net income approach, the value of the company stands at the amount of rupees so and so, and that the overall cost of capital is 15.42%. And again, after conclusion, you can give a note wherein which you tell that according to the assumptions, the corporate tax has not been considered under net income approach. So thereby we conclude the problem. Now this is one of the easiest problems you have. I hope it is clear to you all. If at all it isn't clear, please mention it in your class group so that it can be discussed once again. Now, moving towards the next problem, we just increase the complexity of the problem. Now, under this problem, we shall take three different situations. We shall see how the decisions of the capital structure will change. Now, according to NI approach, what it has said, whenever the debt increase, the value of the firm will also increase. Now, according to that principle, by taking this particular problem, we shall see if NI approach according to its perception stands true or not. Now, the second problem tells that a company named A has expected net operating income to be rupees 50,000. The equity capitalization rate of the company is 12.5%. And they have asked illustrate the net income approach if the company has rupees 2 lakh 10% debentures. The company raises the amount of the debentures by 1 lakh. The company reduces the amount of debentures by 1 lakh. Now, this was all the information that has been given to the problem. Yes. Okay. Now, what has been mentioned in the problem? We'll have to understand the question. The question tells that the EBIT, the first thing it speaks about EBIT, or the earning before interest in tax, or it is the net operating income. All this is to be rupees 50,000. And they have also spoken regarding the equity capitalization rate. Now, equity capitalization rate is nothing but your KE. Now, where will this KE be helpful? This represents the cost of equity, or the what we call as equity capitalization rate. Now, where does this helpful is when we have to find out what is the value of the equity shares. Because when we have EBIT, what we usually do is we deduct the interest and tax, and we have in our hand what would be the net income that would be available for equity shareholders. Now, once after we have that, we would be dividing it with equity capitalization rate, so that we know what is the value of market value of equity shares of the company. And the problem is such that where they speak of debt, what is the debt? Debt is rupees 2 lakh. Now this rupees 2 lakh entirely they have given. They have not mentioned in a split as to how each of the debt is. Or it might be a one debt. It might not be debentures, so that they can give in terms of how much each bond would value. So it is a total amount which has been taken by the company, and the total debt that they have taken is rupees 2 lakh. Now they have 2 lakh of debt and debentures. Now it attracts an interest of 10% on the entire amount. That is the first scenario. In the second scenario, what has happened is the debenture has been raised by 1 lakh. That is to tell, under second scenario, the debenture rate would go for an extent of 3 lakh. How it is 3 lakh? 2 lakh. This 1 lakh would be 3 lakh. And under the third circumstances, they have reduced the amount of debentures by 1. So under third scenario or under situation C, you will have the rate of debt to, the total amount of debt to be 1 lakh. That is 1 lakh because 2 lakh and the company reduced the amount of debentures by 1. So you will be having 1 lakh debt in the situation C or on the third scenario. Now moving with the solution, we'll have to always write calculation of the value of the company under net income approach. And we should remember that here within we have three scenarios. That is situation A, situation B and situation C. Now what has been given? Earning before interest and tax has been given. Now what we should remember is earning before interest and tax is similar to all the three different situations, and they have directly given it to be 50,000. Now here they have to mention the earning before tax is 50,000. So for each of the situation A, situation B and situation C, or scenario A, scenario B and scenario C, the EBIT is 50,000. Now, when you have EBIT, to find earning before tax or EBT, we'll have to deduct interest. Now, the rate of interest and the amount of debt that the company has been taken is also mentioned in the question. The amount of debt, or here to be in particular, the amount of debenture that is issued by the company is 2 lakhs. Now this 2 lakh of debenture attracts an interest of 10%. Now when you multiply 2 lakh with 10%, it will give us the amount of interest. Now, here what should we remember is that for each of the scenario, the amount of the debt is going to change. Under first scenario, the amount of debt is 2 lakh. Under scenario B, the amount of debt would be increased. It would be 2 lakh plus 1 lakh. It would be 3 lakh. Under the situation C or scenario 3, the amount of debentures yet again changes. Here there is a decrease in the amount of debt. That is 2 lakh, which is reduced by 1 lakh. So you will have 1 lakh of debentures. Therefore, for the first situation, it is 2 lakh into 10%. 2 lakh because it has been directly given. For the second situation, it is 2 lakh plus, according to the situation, they have increased the debt by 1 lakh. So altogether it would be 3 lakhs. Now 3 lakhs into 10% would be 30,000. Or in the third situation, it is 2 lakh minus 1 lakh, which will be giving you 1 lakh into 10% would be 10,000. Here what has been mentioned is increase or decrease in the debt. That is, here it is increase. That's why the total amount of debt becomes 3 lakh, which is multiplied by 10, and you would be getting 30,000. And here the debt has been reduced by 1 lakh. Here the debt has been increased. Here the debt has been decreased. Now 2 lakh minus 1 lakh is 1 lakh. 1 lakh into 10,000 is what they have mentioned here. 10,000. So now earning before tax would be 30,000 for company A, 20,000 for company B, and 40,000 for company C. Now, when you see this, what we understand is what is the net income available for equity shareholders. Now, the net income which is available for equity shareholders under scenario A or situation A is 30,000, under situation B it is 20,000, and under situation C it is 40,000. Well, when we see just like this and analyze what has happened, the net income approach says that you know the value of the company increases. But don't confuse the net income available for equity shareholders with the value of the equity or with the value of the firm. Because net income is the profit what we have. From that we'll have to find out the value of the equity. Now, how are we going to find out the value of the equity? We have equity capitalization rate which stands at 12.5%. Now, when you divide the net income available for equity from that of equity capitalization rate, we will be getting the market value of the equity shares for each of the scenarios. So for the first one, it is NI is 30,000, the equity capitalization rate is 0.125 and the total amount of equity shares should go up till 2,40,000. And see what has happened when the company increases the debt beyond a certain extent. When the company has increased the equity stands at rupees 1,60,000. And when it is 40,000 of net income is available for equity shareholders. The value of the shares stands at 3,20,000. Now, now that we have the value of equity with us, we have to find out the value of the debt for each of the scenarios to find out the overall value of the firm. Now, debt for the first scenario has been directly given to be 2 lakh, and for scenario 2, they have increased the debt. So, 2 lakh plus 1 lakh would be 3 lakh, and for situation 3 or for scenario 3, they have reduced the debt. That is 2 lakh minus 1 lakh would be 1 lakh. And so the total value of the firm would go for situation A it would be 4,40,000, for situation B 4,60,000, for situation C 4,20,000. Now see, by using 2 lakh as debt, the company stands at a value of 4,40,000 in the market. When the debt has increased, the value of the company when the debt has increased, the value of the company has also increased for 4,60,000. And with the decrease in the debt, the value of the debt compared to that of this situation has also decreased. And see the cost of capital also. With the optimum structure, it stands at 11.63. Sorry, it is not the optimum capital structure. With the debt of 2 lakh, they have the total cost of capital to be 11.63%. And with the increase in the debt proportion in the capital structure, the overall cost of capital has also decreased. And with the decrease in the debt, the overall cost of capital has increased. Now this is the exactly the same thing what is being proposed by net income approach. That is as and when the debt proportion as and when the debt proportion increases up until a certain point of time in the capital structure, the overall cost of capital decreases and that the value of the firm increases. Now you can find out K naught by one more formula. That is, if at all the EBIT is not being given or the value is not given, you have the rate of debt. It is the cost of debt is KD or KI has been given to be 10%. You have value of the debt, that is 2 lakh for first scenario, 3 lakh for second scenario and 1 lakh for first scenario. And you will be having the value of the firm also, which you have calculated to be 4 lakh 40,000 for first scenario, 4 lakh 60 for second and 4 lakh 20 for the third scenario. And when you added it up with the cost of equity, you will be getting the overall cost of capital. Now, either you use EBIT by B or this formula, the result would be one and the same. Therefore, the conclusion tells that the use of additional debt has caused the total value of the firm to increase and the overall cost of capital to decrease, and conversely or vice versa. Now, this is the conclusion which is expected to be given by you. And note regarding the tax you will have to give. Yes. Now there is problem 3, problem 4 and problem 5 which is expected to be solved by you. Okay. Now all these are simple and easy as that of the first two problem that we have discussed, and thereby we can finish up with the net income approach. Now the third problem tells that X company limited is expecting an annual EBIT of rupees 1 lakh. The company has 4 lakh in 10% debentures. The cost of equity is 12.5%. You are required to calculate the total value of the firm. Also state the overall cost of capital if the company decided to raise 1 lakh rupees by issue of 10% debentures and use the proceeds thereof to redeem equity shares. The company decides to redeem debentures of rupees 1 lakh by using equity shares of rupees 1. And the problem 4 speaks regarding uh, Mahima Limited has a net operating income of rupees 30 million. Now here the problem is regarding million. You'll have to know how much 1 million is in terms of lakhs. So first try to understand the difference between the million and lakh, and based on that go on adding your zeros to your 30. And Mahima Limited employs rupees 100 million of the debt capital carrying 10% interest charges. The equity capital rate applicable to Mahima Limited is 15% interest. What is the market value of the firm under the net income method? Assume that there are no tax. And the last question is, the following information is available for two companies, Box Corporation and Cox Corporation. Net operating income, it is 2100 for both Box Corporation and Cox Corporation. Interest on debt for Box is nil and for that of Cox is 5 lakhs. Cost of equity is 15% each and cost of debt is 10% each. Calculate the market value of the equity, market value of debt, and market value of the firm for Box Corporation and Cox Corporation. What is the average cost of capital for each of the firms? What happens to the average cost of capital of Box Corporation if it employs rupees 30 million of debt to finance a project that yields an operating income of rupees 4 million? What happens to the average cost of capital of Cox Corporation if it sells rupees 10 million of additional equity to retire 10 million of outstanding debt?